Welcome to the 8th episode of our Let's Talk About podcast series, the Luxembourg audio channel for high-level insights and updates. I'm Tomasic, Senior Associate at Dechert, Luxembourg, and today we are unpacking the EU Sustainability Omnibus package. This Omnibus package brings a suite of cross-cutting updates to the EU Sustainable Finance Framework. Its goal is to make sustainability information more decision useful and comparable, embed ESG more deeply into product design and distribution, and curb greenwashing across the market. In practice, that means clearer rules for how sustainability preferences are captured and reflected in investment advice, tighter alignment of disclosure across regime, and more consistent governance, risk management, and data expectation for asset manager, banks and insurers. We will explore what this means for firms operating and through Luxembourg, how it interacts with sustainable finance disclosure regulation and the Corporate Sustainability Reporting Directive, implication for fund documentation and reporting, the impact on debt capital markets and investor demand, and the practical steps organizations should prioritize now. To navigate these developments and what comes next, I'm joined by 4 special guests: Illarionova, Senior Manager ESG Consulting at EY Luxembourg; Julie Pelcé, Senior Associate ESG Specialist at CMS Luxembourg; Miao Li, Head of Debt Capital Markets at BIL; Mihai Stroe, Sustainability Assurance Director at PwC Luxembourg. Julie, before we dive into the details, could you walk us through the context in which this Omnibus package was introduced?
Sure. The Omnibus Sustainability Package arrives after several years of implementation of a number of regulations across the EU sustainable finance landscape. It starts with SFDR and the EU Taxonomy, followed closely by CSRD and the Corporate Sustainability Due Diligence Directive, or CS3D, each covering different levels of reporting and each ambitious in scope and timing. This fast-growing regulatory landscape did come with its limits. Companies and financial institutions faced highly technical disclosures, while member states' regulators confronted practical capacity constraints in transposition and supervision. At the same time, there was a need to find the right balance between preserving comparability without overburdening market players. Finally, the Omnibus package is a political and legal response to remain a competitive market by focusing on disclosures where they are the most decision useful.
Thanks, Julie. That was a really clear scene setter. In this context, the Omnibus package introduced a lot of changes. What are the main impacts from a regulatory perspective?
The first main impact is the reduction of scope, particularly around CSRD. The proposal by the European Commission to limit the scope to companies with over 1,000 employees was already a major cut. About 80% of companies initially in scope would no longer be required to disclose under CSRD. However, the trilogue between the European legislators is likely to result in adopting an even more reduced scope, limiting the application of CSRD to the largest companies. On the 13th of November, the members of the European Parliament indeed suggested applying CSRD only to companies with more than 1,750 employees and an annual turnover of more than 450 million. The second element is the so-called stop-the-clock approach. Rather than suspending the agenda, it pauses and delays most application dates by 2 years to give preparers, assurers, and supervisors room to operationalize the rules. That breathing space is designed to avoid forced refilings and inconsistent data during the first reporting cycles. The third element is the impact on member state implementation. The package effectively resequences national transposition and supervisory expectations. It will likely require member states to adjust legislative calendars, update guidance, and resynchronize enforcement priorities.
Let's stay on the regulatory angle for a moment. How does this Omnibus package tie into the broader ecosystem, particularly the ongoing review of SFDR?
Well, the Omnibus package provides an important stone for the current SFDR revamp. The revision of SFDR will need to take into consideration the resequenced and refocused corporate data environment that the Omnibus will create. Particularly, if Omnibus results in reduced or phased corporate disclosures, whether under the Taxonomy, CSRD or CS3D, that directly affects the data points available to investment managers for SFDR purposes. That said, we should expect the next iteration of SFDR to absorb this reality with a more targeted, decision-useful set of indicators, focusing on what is key information for the investors. That said, we should expect the next iteration of SFDR to absorb this reality with a more targeted, decision-useful set of indicators, focusing on what is key information for the investors. We, however, hope that the aim of transparency and comparability is preserved by aligning SFDR with the Omnibus data architecture, so managers report what is robustly available and investors receive disclosures that are consistent and meaningful for their investment decision.
Thank you, Julie. That really sets the tone. Hannah, let's widen the lens. Beyond CSRD, what other parts of the sustainable finance framework are reshaped by the Omnibus proposal, and what does this mean for Luxembourg financial sectors?
Thank you. Indeed, aside from proposed changes to CSRD, the Omnibus proposal has implications on other regulations, such as EU Taxonomy and CS3D, Due Diligence Directive. In July 2025, the updated Taxonomy Delegated Act proposes to reduce reporting templates by 64%, simplify the technical principle do no significant harm, and exempt non-material activities that represent less than 10% of the total assets. The text is still under scrutiny, but is expected to come into effect from January 2026. In terms of CS3D, the proposal targets to reduce the number of entities in scope and also include the limitation of the value chain to direct suppliers. As you can see, the Omnibus proposal brings some relief, especially in terms of timelines and complexity to the Luxembourg financial sector. However, it also introduces regulatory uncertainty. Speaking about CSRD, companies subject to different waves of reporting are experiencing different challenges. For instance, Wave 1 reporters that were supposed to apply CSRD from financial year 2024 were in the regulatory uncertainty as Luxembourg hadn't transposed the directive into the national law. Wave 2 and 3 reporters that will be subject to CSRD in 2027 and 2028 financial years respectively, thanks to the introduction of the Stop the Clock amendments, are still expecting the validation of new CSRD thresholds to check the applicability of the directive to them. In addition, even though 2 years sounds like plenty of time, Wave 2 and 3 firms need to factor in data collection and assurance cycles, so waiting until EU finalizes the proposal may cause quite significant compliance risks. European Sustainability Reporting Standards, ESRS, are in the phase of revision that requires close monitoring of the changes to come. As the revision will be finalized only in 2026, financial institutions might still need to prepare disclosures under the old variant of standards before the new rules take the effect. Recent November vote indicated that simplification is forthcoming and the proposal is moving to trilogues. However, financial institutions must continue to build resilience to anticipate changes and to ensure that their sustainability strategy and performance are up to date.
Thanks a lot, Hannah. That gives us a good sense of the broader landscape. So looking ahead, what should Luxembourg financial institutions prioritize right now to stay on the track?
Even with 2 years stop the clock and higher thresholds of application for omnibus directives, the time to act is really now to be fully prepared. Here are some 5 key steps and tips for our podcast listeners. First and foremost, do not pause your sustainability strategy. Even if your organization is temporarily out of scope, the long-term direction is clear. Sustainability is becoming embedded in how financial institutions operate, assess risk, communicate with stakeholders. Continuing to build and refine your ESG approach will make sure that you are prepared when the rules come into force. Second, invest in automation and data quality. One of the biggest challenges in ESG reporting is gathering consistent, reliable data across different systems and teams. By improving your internal data infrastructure, whether through digital tools, AI capabilities, better integration, or clearer governance, will help you to be better equipped to meet future reporting requirements efficiently and accurately. Third, develop transition plans and enhance the ESG risk management framework. Upcoming requirements like European Banking Authority's guidelines for ESG risks are evolving in parallel to the Omnibus proposal. It's a lot about resilience. Having a clear plan for how your institution will adapt to low-carbon, more sustainable economy will lower your risk exposures and maintain competitiveness in the long term. Fourth, build internal capacity and awareness. ESG affects multiple teams: risk, compliance, strategy, client services, training staff, keeping informed your ExCo and board. Embedding ESG into decision-making processes will help ensure your organization is ready for what's next. And finally, stay closely informed. The Omnibus proposal is not finalized. Technical standards and delegated acts will define how institutions need to respond. Keeping up with legislative updates, industry guidelines, best practices will help you stay agile and avoid last-minute surprises.
Thank you, Anna. Lots of very actionable points there. Miao, let's shift to the market side. What role do debt capital markets banks play in this evolving framework?
Yes, Thomas. DCM banks as intermediary in the sustainable finance market, our role is in twofold. We support issuers on the one side and investors on the other. On the issuer side, large companies that have already issued in green or sustainable bonds would likely not see any major changes. Maybe they will need to adapt their reporting, but let's say overall, they have built up an ESG credibility and they're committed to maintain it. But for smaller issuers, the Omnibus package would make a real difference. The reduced reporting requirement would lower the barrier to entry, especially for those who has hesitations due to operational or resource constraints. On the investor side, I would say expectations are still high. Most investors would expect alignment of international standards, such as the ICMA principles. Many rely on secondary opinions or external ESG ratings. Well, the most sophisticated investors would apply their own internal model to assess sustainability performance. So even though with the regulation simplification, transparency remains essential. Therefore, I would say banks need to help issuers meet market expectations while navigating this new regulatory landscape, whether it's through structuring support, ESG advisor, or coordinating with the right service providers, such as ESG data platforms or certification bodies.
Really interesting perspective, Miao. Mihai, from an audit and insurance standpoint, what best practices are emerging for Luxembourg players as they prepare for these changes?
If we look at how leading players are responding, it's clear they're not waiting for full legal certainty. Many are already conducting gap analysis against the expected requirements. They're enhancing their governance structures, and they're making sure that sustainability information receives the same or similar level of scrutiny as financial data. We also see more organizations piloting early voluntary assurance exercises, and this is proving extremely helpful to identify process gaps, to perform stress test controls, and prepare teams before assurance becomes mandatory. Technology is another critical enabler. In one of our recent studies, more than 80% of the companies are planning or have already adopted new reporting tools or data platforms to support CSRD-aligned reporting. I believe this reflects the reality that data quality and consistency remain the top operational challenges, and technology is here as being key to addressing them.
And if we look at the challenges, where do organizations still struggle the most, and how can they start closing those gaps?
Of course, several challenges remain. Data quality, it's still uneven, and ESG and finance team in many organizations are still learning to speak the same operational language. The Omnibus package does provide some breathing space, but that time should be used wisely to focus on building robust systems for a better and clearer governance, and also to develop stronger sustainability culture. And I believe for many institutions, continuing or initiating voluntary assurance over parts of their sustainability reporting can be a very powerful way to test their readiness, to strengthen internal control, and support a smoother transition to a more mature reporting process. I would say overall, we are seeing a shift from rapid, deadline-driven compliance towards sustainable, long-term implementation.
Thanks, Mihai. That was very insightful. Miao, coming back to the bigger picture, how does Luxembourg fit into this landscape, given its role in global sustainable finance?
I would say Luxembourg plays a leading role in the broader sustainable finance landscape. It's not just a listing venue, although it's well known for it. It offers also a combination of infrastructure, legal certainty, and market expertise that supports both ends of that value chain. From an issuer perspective, Luxembourg provides access to a broad range of financing instruments, including labeled bonds, sustainability-linked bonds, and securitization vehicles, and which each type of them are supported by a strong track record of successful transactions. Its legal framework is flexible enough to accommodate both standard and innovative structures. And this can be particularly useful for smaller or first-time issuers who may need these tailor-made solutions well aligned with international standards. In between, Luxembourg also provides a well-established ecosystem of ESG service providers. On top of banks, you have excellent external reviewers, data platforms, and legal advisors who may help issuers to meet this disclosure and verification requirements more efficiently. On the investor side, Luxembourg maintains a reputation for transparency and regulatory reliability. Its regulatory framework are aligned with EU standards. It hosts a large number of sustainable investment funds that further adds to market depth and credibility. So in practice, Luxembourg helps bridge the gap between regulatory simplification and market expectations. So it offers a platform where issuers get access to international capital to support their sustainable strategy while being able to still meet those requirements of transparency and quality standards that major investors would expect.
Thank you, Miao. Before we wrap up, Mihai, in your view, what are the biggest wins of the Omnibus package? I mean, where does it bring the most value for firms, investors, and the market?
I'm happy as an auditor to share also positive news. And for me, one of the most positive aspects of the EU Sustainability Omnibus package is that it brings a real sense of pragmatism to the EU sustainability agenda. Over the past few years, we have seen impressive progress, new regulations, new data expectations, new reporting cycles, but also growing complexity and some degree of regulatory fatigue. By adapting and streamlining the scope and the timelines, the Omnibus package helps the market shift its emphasis away from simply trying to meet deadlines towards improving the quality and consistency of sustainability data. The focus now becomes decision-useful information rather than pure compliance. I would add that from an audit and assurance standpoint, the Omnibus amendments, I believe, will provide much more needed clarity on the audit expectations for CSRD. They give both preparers and assurers additional time to establish audit-ready data flows, to strengthen internal controls, and align methodologies with ESRS requirements. This ultimately supports a more consistent basis for limited assurance and reduces the risks of late-stage audit findings.
Thank you, Mihai. We've come to the end of this episode. Thank you, Mihai, again. Thank you, Hannah, Julie, and Miao for all of your valuable insight on these topics. If I have to summarize the key takeaway, for me, they are that the Omnibus package is a chance to simplify and refocus, and is not a signal to slow down because it encourages the building of smarter, more resilient ESG practices that should stand the test of time. It should narrow the CSRD scope and is expecting to introduce a 2-year pause in application date, subject to the European Parliament, the Council of Europe, and the European Commission outcomes and national transposition, so companies, assurers, and supervisors have time to operationalize the rules. For Luxembourg firms, the direction should remain the same, and they should keep executing their sustainability strategies, invest in data and automation, and strengthen ESG risk management, transition plans, and internal capacity. Debt capital market banks should remain pivotal intermediaries, as they can help smaller issuers deliver investor-grade transparency within a simplified yet still demanding framework while meeting market expectations. Luxembourg's ecosystem, which combines legal certainty, flexible structuring, and deep ESG services, should continue to bridge regulatory change with market expectations, and the upside should be more time to get it right, better data quality and controls, and greater confidence for investors and regulators as the market shifts from rapid compliance to durable implementation. Dear audience, we hope you enjoyed the discussion and took away some valuable insights. Don't forget to leave us a review and share your thoughts on the LuxCMA LinkedIn page. We would love to hear your take. Make sure to subscribe to the Lux Talk About podcast on Spotify for more expert perspectives and upcoming episodes as we come to explore the latest trends shaping the world of sustainable finance. You can also find this episode and all previous ones on the LuxCMA YouTube channel. This marks our final episode of 225 before the holiday season. On behalf of Sustainable Finance Working Group and the entire LuxCMA, we wish you a wonderful and restful holiday season. We will be back in 2026, kicking off the year with an exciting discussion on blue bonds. So stay tuned. Until then, keep thinking green and see you next year.